Welcome back. So there's two panel sessions now between the sort of closing speech and where we are now. So the ambition for this particular 40-minute slot is to discuss net zero. There was a session before lunch, but I think we're going to specifically look to investigate how we can use sustainable investment to help sort of chart a path towards successful outcomes. Before we get on to the detail, though, just a few brief introductions to go with the giant photos of Andy and I you can see on the screen. I'm Steve Bowles, so I sit within the Schroders Institutional Client Group and focus on engaging with our clients and their advisors around sustainability. And we see that dialogue as very much a two-way conversation, socialising externally the work that we do internally with our clients, but as importantly, bringing back into the group knowledge and awareness of the challenges that our clients are facing and what their focus on is around sustainability. And I think the hope that today's session will be reasonably interactive and that we can continue that sort of trend of a two-way dialogue with you. Sitting with me and only metaphorically in the hot seat because we've been unable to find a fire for our fireside chat is Andy Howard. So Andy's Global Head of Sustainability and leads our global sustainable efforts as a team of 50 specialists that we have dotted around the globe. And they cover areas such as ESG integration, so making sure that sustainability is incorporated at a fundamental level into the investment processes across all of our investment desks. Sustainable research, so providing actionable insights both to our investors but also to our clients. And then I guess the final pillar is that sort of active ownership pillar, so that process of us engaging with the companies that we invest in to achieve our sustainable objectives and also exercising those voting rights on behalf of our clients. So we've got, let's see if we move that on. So you'll see that this slide covers some of our key credentials. You're going to be delighted to know that I don't have a 15-slide Schroders marketing presentation here, but I did think it was worth just highlighting a couple of credentials which I think are particularly salient to the conversation that we're going to have today around net zero. So Schroders are the largest asset manager to date to have our net zero targets formally validated by the Science Based Targets initiative. We were also a founding member of the Net Zero Asset Managers Group, and we've committed to aligning all of our investments to a 1.5 degree pathway by 2040. So I think we're reasonably well placed as a firm to provide you with some of our experiences on net zero and hopefully provide you with some insights and answer some of your questions as well. Just as per the other sessions today, please do send through your questions by Slido. I have my trusty iPad. It works. I can pick them up, so you can send those through. Or just as per other sessions, just put your hands in the air and we'll try and get through as many questions as we can in the session. This is definitely not meant to be a presentation. So in the absence of your questions, Andy's going to get a range of pre-prepared questions from me, which will enable him to have a couple of free hits if you're not prepared to sort of engage with questions for us. So anyway, enough from me. Andy, just to get things going, while the audience have a chance to think about some questions, I thought it might be helpful to start things off with a bigger picture question. So what have been your experiences of Schroders' journey to net zero so far? And I guess what have been some of the challenges and surprises that you've experienced along the way?
Yeah, I mean, if I think back to the point a couple of years ago where we were having the conversation, should we make formal commitment statements of ambition or goals in terms of our transition? You've mentioned there the Net Zero Asset Manager Initiative. You've mentioned the Science Based Targets Initiative. And bluntly, these were, I keep getting asked by peer organisations, how did you go through the process of persuading the CEO to do this? Or how did you persuade the heads of investment to make this sort of transition? The reality is it took about 5 minutes. There has long been a belief within Schroders that climate change is a challenge that will become more important over time, that the world will, over time, transition to a net zero pathway or to a lower decarbonisation pathway. We can debate the timing, we can debate the speed, but it's almost effectively an inevitability that over time, climate change is something that we will have to deal with within portfolios, and we can either approach that proactively or we can approach it passively. And I sort of say that because I think it's important. I think it's a very difficult process. If we don't have an organizational belief that this is something that we need to do, it would have been very tricky to see how it would be like herding cats in terms of trying to figure out how do we bring different investment teams, how do we bring the organization along. If it had been thought of as a marketing exercise, other organizations have joined up to this, so we should probably do something too. But there wasn't inherently an understanding or a recognition that this was something that we were going to have to deal with in any case. It would have been a much more tricky process. And it would start off relatively simple because transition by definition means that you're sort of moving gradually over time. And the first few years are reasonably straightforward. But I think it becomes progressively and exponentially harder as time passes if there isn't a belief that this is a decision, and a difficult decision, that needs to be made about how portfolios are managed and how portfolios will need to evolve in the future. And so the conversation itself around setting targets or stating ambitions was reasonably simple. And a lot of the backdrop to that was a recognition. There are a few slides, apologies. Makes it a bit more visual. But the left-hand picture shows the number of countries around the world that have set some form of net zero commitment. These vary, frankly, in scope from legally binding commitments to statements of intent, depending on the jurisdiction. But you're now at a point where around numbers, 90%-ish of the world's economy and 90% of the world's emissions come from countries that have established net zero targets. Typically by 2050, sometimes a little bit earlier, sometimes a little bit later, but by around about mid-century. So that transition from kind of a few percent in the year or so after the Paris Accord in 2015 to now the very large majority of the world's economy on some sort of statement of intent, the transition is a very significant change, I would say, in a relatively short period of time. And we're seeing companies begin to respond to that. As you can see on the right-hand side is just a chart showing the number and the value of companies that have set either targets or committed to setting targets through the Science Based Targets Initiative. Again, an indication of change. It's the main initiative for climate target setting. The little green line is the share of global equity markets in rough terms. The blue line or the blue bars are the number of companies that have established those targets. So notwithstanding all of the noise and all of the news flow over the last 12, 18 months about whether it be linked to Ukraine and commodity prices, whether it be linked to the sort of ESG backlash that we've seen in the US, the momentum in terms of, in particular, company setting targets, I think there's not much room for more governments to do something similar, has been pretty clear. So against that backdrop, for us, it was a reasonably straightforward exercise to ask the question, well, as this plays out, this will have a bearing on the portfolios that we're managing. And as a consequence, we have to think now about how we're going to manage portfolios differently in the future and how we're going to align portfolios with the world that we're heading into rather than the world that we've come from. So it was a reasonably straightforward exercise. Our life at this stage, to talk about challenges, would have been simpler in some ways, were it not for fund managers and humans who, quite rightly, keep us honest in terms of the approach. Decarbonisation as a purely mathematical exercise isn't that tricky for the first 5 or 10 years in terms of how do you reduce portfolio emissions, given the nature of the way that portfolios or emissions are skewed across the market. You can eliminate half the emissions in the market by excluding 10, 15% of the equity market, would get you to a universe that's got about half the emissions of the unadjusted equity market. So on the face of it, it becomes reasonably straightforward. And you can take that to its logical conclusion and kind of gradually exclude more and more of the market so that portfolios decarbonize. And mathematically, you're on the right pathway. From an investment point of view, create significant challenges. And I think that's, whilst mathematically the numbers work out, you can reduce emissions in that way. What it does effectively, it creates a growing constraint and a growing cost in terms of diversification. As you play that through, that cost starts relatively small, frankly, and kind of grows exponentially over time as time passes. And our focus really was very much on asking the question, how are we going to think about transitioning portfolios in a way that doesn't cost in terms of diversification or in terms of risk management, and actually preferably exposes portfolios to sources of opportunity and sources of investment return within markets. And so, as Stephen sort of mentioned, our approach has been very much focused on transition. And so looking for companies that are themselves ready to transition, able to transition, willing to transition, and where through our engagement, we can influence and support that transition by those companies. So what the chart on the left-hand side shows is over the last 5 years, if you break up companies into the best, next best, so 5 different quintiles of carbon emission changes over the last 5 years relative to their sector, so it's sort of sector relative emissions performance over a 5-year time frame. The blue line, the blue bars show you the total shareholder return for companies that have done the best in terms of emissions reductions on the left versus companies that have done the worst. The green line or the green bars for reference are the earnings growth of the same companies. So the point being basically that if you had correctly identified the companies that went on to cut their emissions the most, you'd have outperformed by about 4% a year over that 5-year time frame. So that's looking backwards. It's a historical number. It assumes that you had something of a crystal ball in knowing which companies were going to go on to decarbonize. But again, it does underline the fact that where companies can transition, where companies can decarbonize, it can release and create value for shareholders, as well as obviously the benefits in terms of emissions reductions in the real world and in the real economy. And so our focus has been very much on, well, that's all well and good. We don't have a crystal ball. What analysis can we do to identify those companies that are more susceptible or more likely to transition? And how can we use our voice and influence to encourage that transition through the way that we engage with those companies, through the way that we use our voice and influence with those companies, so through engagement or through voting. And so that's been, frankly, challenges-wise, it's a lot harder work than just putting some portfolio restrictions and some exclusions on different portfolios. On the other hand, it's been a lot more sensible in our mind and rewarding in terms of ensuring that the way that we're going about this is going to be supportive of investment goals rather than a constraint against investment goals, which may start small, but which would grow over time. The next biggest challenge, I think, is really around government policy and the degree to which we see government action come through to support the policy or the ambitions that we have and the transition journey that we think will be necessary. So whilst, we can come back to, we think the transition towards net zero will be required and will play out, the timing and the sort of urgency of that is going to depend in no small part on the degree to which we see policymakers follow through on ambitions with actual policies to deliver those ambitions, whether that be around phasing out coal-fired power stations, whether that be around electric vehicle electrification, whether that be around efficiency standards on new buildings or on industrial equipment. All of those policies are going to be what drive real change and ensure there's an alignment between decarbonisation and value creation. And I think that, to my mind, is one, I wouldn't say it's necessarily a challenge, but it's certainly one of the unknowns, is do we see that policy come through? And this is, I guess, probably partly tempered by being in the UK over the last few weeks and some of the news flow that we've seen, but it's to some degree a question mark globally in terms of how quickly do we see that policy response and that policy action come through to support delivery of those goals. So we do engage with policymakers. It's invariably a somewhat mixed discussion. And I think there's a degree of trepidation in some parts of the world and in some parts of governments in terms of how quickly that transition can play out. But that is going to be important in really unlocking the value and the volume of capital that will be needed to support this transition, rather than simply thinking about this as being a niche part of the industry in terms of climate-specific finance or climate finance. It's not about creating a climate finance industry. It's ultimately about embedding climate into the finance industry as a whole. And that's going to require, say, more widespread political and regulatory change, I think, to allow that to happen.
Thanks, Andy. No. That's a broad-ranging response to a broad-ranging question. I've got a Slido question, which actually chimes with one of my pre-prepared questions. That's quite helpful. But I'll just check with the audience first to see whether there are any sort of reactions to that, any areas that you want to drill down into, any sort of questions. Yes, we've got a question just over here. I don't know if there's a mic or not anymore. Just shout out. Yeah, go on.
Harry and Dorian, Duty Alliance, and also on both sides of things, the global steel manufacturer and also as a large institutional investor. Thank you.
we've set out our transition plan for how we're going to transition a global steel manufacturing business, which is not straightforward. We think it'll work, but then sitting with my USS hat on, looking at others' transition plans, to what extent have you had to change the makeup of your team, upskill in some real hard technical stuff to be able to assess whether the industries in which you're investing are actually likely to transition? Because I imagine if they can't, if you predict that they're going to be somewhere on the left-hand side of your chart, and actually it turns out that they don't move in the way that they think they're going to, presumably that's a big risk within the portfolio.
Absolutely. The team has changed. So have a look at the sustainable investment team. We've now got, I'm trying to do the maths quickly in my head, but 5 or 6 people who are focused on climate change, whether that's through engagement and through the asset active ownership piece, whether that's through research, whether that's through data analysis. There's a number of specialists, say 5 or 6 people who are, probably 7 if we include actually other parts of the business. So a reasonable number of people focus on specifically climate change and how do we look at this. On the other hand, I would also say, to a certain degree, whilst climate change is extremely tricky, it is one of the areas where there's a huge amount of research that we can draw on in the rest of the world, whether that's academic research, whether that's industry research, in terms of transition pathways and transition-related technologies and livelihoods for different sectors. So when we're talking to steel companies, let's keep the context, a lot of our discussion is around how do you think this will work? Over what does that pathway look like? Because it's not going to be a linear pathway. And we always like to draw straight lines on the page. They're not all going to necessarily be straight lines. But what does that pathway look like? Does that look credible from our understanding of your business and your industry? And then really trying to hold companies to account in terms of delivery against milestones towards that. Now, the challenge there is that that takes time, because understanding whether companies are on track or not can take years. You've got a lag in terms of data being reported, and then trying to judge things from one year to the next is probably too short a time frame in the first place. So it takes a long time to try and understand whether companies are on track for delivering against the sort of pathways that they've outlined. So we do try to look beyond that at, are companies doing the things that we would expect companies to do if they're going to be more likely to deliver those transitions? So that, for example, have they got the right level of ownership within the organization? Is there an incentive structure that's aligned to delivery of those targets? Is a company using, for example, is it using carbon pricing in shadow carbon pricing in internal capital allocation decisions? Is a company investing appropriately in green R&D or in green technologies that will support the transition that it's described? And trying to look at it through that lens. So it doesn't just become about, let's wait 5 years and see where we are, but can we see the indicators that would indicate delivery of that transition? So there has been a change, but I think we also recognize we can't be experts in every industry. For every steel industry, there's a chemicals industry, which in itself has a gazillion different subsectors. There is a large part of understanding enough to understand whether the plan sounds credible and looks credible, but then equally, to a large degree, ensuring that we're working with companies and engaging with those companies over time to see whether we're seeing the changes that we would expect and whether we're seeing the transition that we would anticipate.
Any sort of follow-on or any other thoughts to that? Any other questions that the audience have at the moment?
Quickly, just following on and looking at transition plans. Greg Watson, Partnership Capital. In looking at transition plans, how closely do you assess the large companies' innovation, scale-up and collaboration skills? Is that an important part of what you look at in assessing whether they're going to get to the goals that they're after, or are you not looking at that yet?
So it's an important part of it. I'll look at it through a slightly different lens, which how well can we do that from the outside in, which I think is not as well as I would like. And part of what we're trying to work out at the moment is how do we effectively measure that from the outside. We can look at things like number of green patents that come, or climate-related patents that different companies are registering. To a large degree, that tends to give you a product focus in many companies in terms of whether they're developing green products, rather than necessarily whether they're investing in the changes to it to adapt their own business model. For the most part, we can look at sort of indicators in terms of R&D spend. We can look at things like what sort of technologies companies are planning to deploy or what they're planning to develop, what partnerships they put in place. Doing that in a systematic way is challenging. And one of the things is goes slightly beyond the climate question, but trying to understand the effectiveness of different companies' R&D spending is a challenge that we've grappled with for some time. I think we're getting better at it, but it's a less objective question than does the CEO have as part of his remuneration scheme climate-related targets as a component of how he or she is paid is a relatively more black and white question. So it's definitely a really important question. I feel like we're probably as an industry, and certainly as Schroders, can get better at answering that question. So we look at it as best we can, but I think we can do better at answering it.
Thank you very much, Andy. How do you think that the indexing industry is going to adapt to all these challenges? MSCI, all those indexing, particularly, for investors educated in modern portfolio theory, diversifying, buying the whole market, without the skills to take into account all these risks, all these things, and who don't even want to do it because it is too complicated. They just want to save their savings, invest their savings in an index, in a low-cost index. How do you see that industry evolving, and that theory, investment theory, that we have all being educated in business school?
Yeah, no, I think, and obviously there's a fairly obvious bias that we're an active manager. But I do think so I sort of think about this a little bit like driving through the rear view mirror. When you're on a straight road, you can drive reasonably safely through. I haven't tried this, but I'm assuming you can drive reasonably straightly through the rear view mirror by looking at where you've come from, and as long as you've got roughly the same amount of road on either side, you're probably going to be okay. When the road starts to turn, you crash quite quickly when you're driving through the rear view mirror. And I think in many cases, a benchmark comprising companies which have been successful have become successful because they've had the characteristics to have allowed them to become successful in terms of their business model, their sources of competitive advantage in the past, are not going to be the same companies or the same performance drivers, competitive drivers that will allow companies to be successful in the future. As a result, the positioning portfolios for the world that we're heading to rather than the world that we've come from is going to require a deviation from benchmarks. It becomes unavoidable that there will be some of today's companies that won't make it to the future or won't be successful in the future. If you look at this over time, I'd say it's become on the one hand, if you like, the degree of change or disruption in equity markets has increased. On the other hand, many of the competitive forces have been reasonably consistent over time. If you look at climate change, however, on our numbers, roughly speaking, about 20% of the value, or 15 to 20% of the value of global equity markets in aggregate is at risk as a result of carbon pricing, physical risks related to climate change, stranded assets, and the changes in demand patterns for different kinds of products. You've got a fairly material risk. Taking that a step further, you've got about a third of companies whose profitability would effectively be wiped out as that transition plays out. So I think you've got a fundamental challenge that if you start from a view that the market is right and the market prices all future risks correctly, which is a sort of tenet to a certain degree, not necessarily correctly, but using all available information, which is a sort of fairly central tenet of passive index ownership, that I think that view is going to be increasingly challenged if we see more disruptive costs or opportunities or financial drivers coming into the corporate world as a result of climate change, which you can't backtest. So one of the challenges that we also run into is that if you try and say, well, how most things that we do in finance, you sort of try and look back over the last 20 years and sort of backtest everything. It's a sort of go-to way of trying to test stuff. In reality, it doesn't work here. I mean, if you go back over most of the last 20 years, carbon pricing was too low to have a meaningful impact on companies' profitability. You just simply didn't have a way of being able to backtest most of the things that we think will play out in the future. So it becomes a question, therefore, of logic rather than backtestability. And I do think personally think it's a challenge. You've got you are beginning to see the emergence of things like Paris-aligned benchmarks, low carbon indices, which offer benchmark, sort of basically low tracking error against standard benchmarks. To a certain degree, to me, they seem often like simple, slightly over simple solutions to a much more complex problem, as in how do you have benchmark returns whilst also meeting a climate target without necessarily thinking too hard about how do I invest actually in transition? It's just a different way of trying to optimize within a constraint while still delivering a market return. And I do think, to put it slightly differently, the question or the supremacy or the tendency, the drift towards owning the whole market in an environment where the market, I don't think, has still got anywhere near reflecting the risks that we're likely to see in the future as a result of a climate transition, is a more challenged strategy than simply than trying to, at least as best we can, understand the direction or the areas in which the market may be challenged in particular and trying to manage the risk associated with that. It does rely, therefore, on a belief that financial markets, equity markets haven't done a particularly good job to date of capturing information about how climate change may impact the valuations of individual companies. Personally, I feel fairly comfortable that's a reasonable solution because there is no back testing. There's no particularly agreed solution as to how this should work or which company is going to be more or less challenged. You too, to some degree, see it in companies like coal companies or companies where there's the most obvious exposure to climate change. And you've seen valuation derating as a result in many of those sectors. But for the most part, I don't think the equity market has got the tools, given the way financial markets work, to properly capture and reflect those risks within the way that they're being valued today. So I do think there is a real potential challenge, I should try and pick my words here, to owning the market in an environment in which the market itself is being structurally questioned or disrupted by climate change.
Just there's a couple of questions come through Slido. There's a couple of hands in the room as well, but I'll just take a couple of these because there's one here that's about how we've built the just transition into our targets, which kind of chimes with a question that we were perhaps going to cover, which is this sort of increase in the interest in the social perspective and how that impacts net zero as well. So if you could just provide a few thoughts around those sort of linked areas, Andy.
So I think you've got sort of two ways of looking at the sort of just transition question. How do you ensure that there's an equity and that people benefit from the transition? People, societies, communities, employees benefit from the transition. So I think on the one hand, you look at it as an equity question. You look at it as a question of fairness and treatment of people, which is a perfectly sensible way of looking at it. I think a slightly more hard-nosed way of looking at it is unless companies or unless governments are looking at the justness of the transition, has a significant bearing on whether that transition will happen in the first place. So I think that unless, for example, companies are able to think about how they're helping their workforce to transition. If you're a car company going from making almost entirely internal combustion engine cars and planning to transition almost entirely to electric cars over a 5-10 year period, you have to think about the workforce, because if you're not doing that, you're going to face a real problem from unions who are going to significantly slow down your transition plan. I think there is within companies often a tendency to think about decarbonisation or transition plans as a bit of a mathematical carbon reduction exercise rather than a human exercise or a real world exercise, which for the most part it is. And justness needs to be baked into that for it to be a credible plan. So it sort of goes back a little bit to the transition plan question. It's not a transition plan in the purely mathematical sense of the word. It's a transition plan in the, is this a practical set of actions? And is this going to be feasible in practice? And if people don't, if stakeholders are not benefiting from that transition, at least in the aggregate, or at least in sufficient volumes, then it's going to be very hard for companies to deliver that strategy. And I think the same thing applies at a government level. We've seen the same thing here to a certain degree. Let's not get too stuck on the ULEZ situation or the Gilets jaunes in France, or if you think about kind of some of the reactions that we've seen to perceived, and I think it's often perceived rather than necessarily real, but perceived costs to climate action. In many cases, I think it's just underlining that unless governments can ensure that those stakeholders feel like they're benefiting from this transition, they understand the benefits of what governments are trying to do, it's going to be very hard for governments to deliver those transitions in the first place. So we do look at it, I think, to a certain degree through a fairness question, and that's a very important question. And we've worked with a number of different organisations in the right way of assessing that, but equally through the lens of, and it's also a more pragmatic question of, unless the transition is just, it's going to be very difficult to transition in the first place. And you can see, I mean, won't name names, but sort of just going back to the car company example, we spent a lot of time talking to a particularly large German car company about its own transition plan, which made perfect sense on paper, but missed the fact slightly that German automotive industry unions are pretty powerful, and unless companies were thinking about how the workforce was going to be evolved and adapted as a result of that, it was going to be very hard to execute on it, even if the maths all played out in practice in terms of where they were developing new plants and R&D and new product launches, all the maths played out, but there was a sort of practical question of the deliverability.
So I'll just paraphrase this question here, because it's an interesting one. You might not thank me for this. So I think that the question is basically saying that potentially there's some sort of negative impacts on the valuations of asset managers that are most embedded into sustainability, and they were kind of referencing the Schroders share price. But I mean, I guess it links to a bigger issue, and you know, we've seen it in the States and Europe of this sort of dichotomy of approaches and markets, and the impact that can have on asset managers and their ability to source clients. So it's probably a slightly broader question, but I just didn't know if you had any thoughts on that.
Yeah, I think, I mean, source clients. So I think a lot of this will come down to how rather than what. So what I mean by that is it's relatively straightforward. Bluntly, it's reasonably straightforward to set a net zero target in mathematical terms. You figure out what your emissions are at the moment, you figure out when you want to be zero or when you want to be at some future level, and you draw a line between the two, and you've got a target on paper. The question all comes down, certainly in our mind, to how are you going to get there? And are you developing an investment strategy and an investment process that will benefit clients as a result of how you're going about that journey, or that will cost clients? Because ultimately, at the end of the day, I think a lot of the challenges for organizations that try to think about this as a series of constraints are going to be very real challenges. There is, certainly we see this amongst our own client base. We've got the whole spectrum. We were on most of the blacklists available to us in the US, amongst the various states, so Texas most initially, and then Oklahoma, Kentucky. On the other hand, we also get beaten up by clients that want us to do more. And I think the last 18 months, 2 years or so has been an interesting journey within Schroders in really clarifying we need to be really clear about why we're doing this and how we're doing this. And we need to communicate that as effectively as we can, rather than trying to keep everyone happy, because it's impossible to keep everyone happy. It just about used to be possible, if I'm being honest, a couple of years ago. You could just about form some form of words that just about kept everyone more or less on the same page. Doesn't work anymore. You've just got to be clear, we are doing this because we believe that there is a increasing probability that the world will transition towards net zero. Is it going to be 2050? I don't know. But we do know that there will be, or certainly our belief is that net zero will come, whether that's in 2050, 2060, 2040, we are going to transition towards ultimately a net zero economy. However you cut it, whichever of those dates you choose, against a backdrop in which over the last 50 years, there have been 3 years in which emissions have fallen globally, and every single year they bounce back again the following year, when that's happened, that this is going to be a disruptive change. And it doesn't really matter too much whether it's a 7% drop a year, 6%, 5%, 8%. Either way, all of the solutions, the things that we should be doing as asset managers are pretty similar in all of these scenarios. So I think ultimately there is the question is, why are you doing this and how are you doing this as an asset manager? If you're approaching this as a question as an asset manager of, we think we should be doing this because more than half the world's asset management industry has now joined up to the Net Zero Asset Management Initiative, so we should too. We should make some statements about how we're going to do it. We haven't really thought through how, why, what, how is this going to actually impact and influence how we invest capital, then you're going to be in a bit of a pickle, because you're going to find over time that this becomes a constraint on the one thing that unites nearly all of our clients is an appetite and a desire to generate returns. And different people want to see that being done in different ways. But if it starts to become a constraint, or you haven't thought about it as an investment question, I think it is going to be a challenge. I think certainly our experience in terms of, as you put it, client interest has been, most of our clients remain and have remained through the last few years very focused on sustainability, not just in terms of sustainable funds, but equally in terms of how we approach sustainability as an organization. Again, to give you a data point, in 2016, less than 10% of the RFPs that we received as a firm had questions around sustainability. It's now over 90%. So pretty much every RFP that we engage with has got questions around sustainability, and more than half of those questions are what we would classify as detailed questions, loose definitions, but more detailed question certainly than have you signed a PRI and do you have an ESG policy? And so what we're seeing on the ground is that our clients are interested, that we are seeing more demand for sustainable funds. But in reality, it's also going to come down to, we're doing this because we think this is how value will be created. We have beliefs in lots of different areas, lots of different asset managers do. We believe in the value of active management. We believe in the value of active ownership. It's a belief statement. It's supported by evidence, but it's a belief statement nonetheless. And that's how we are managing portfolios and why we're managing portfolios in the way that we do. And I think in the end, time will tell. But I think most of the other side of the story is embedded in I'll just pick on them here because they're not here, but the sort of Texas view of the world is a belief that all of this isn't going to happen. So if you believe that climate change is not a real thing, that governments are making some noise, but they're not actually going to do anything about this, then Texas might be right. I just struggle to see how that can be true.
Probably got a few minutes left, time for at least one more question. There was a gentleman at the back, I think, who had his hand up first, then we'll have to see where we get to, I'm afraid.
Hi, as Priyank, I work for Deloitte Data Analytics. So obvious question, integrating climate comes with a cost. And in the world right now, with cost income ratios being a big challenge, what's your thinking around how do you manage the cost versus also bringing it real decisions, which is really important right now?
It does come at a cost. So the data providers and others do charge a fair bit of money. I mentioned the growth in climate specialism that we have within the firm. I think it's going to be a challenge, and we observe this as well. It's a challenge for smaller organizations, whether they be smaller asset managers or whether they be small asset owners, in terms of how to monitor and measure these things. But I also feel like we sometimes get a bit stuck on data. Sometimes we get a bit too stuck on, well, we need the data to be perfect. The reality is none of this data is perfect. I think the question of we need to engage companies and understand their transition plans and then hold them accountable for delivering against those plans, you could kind of do even if you didn't have any data. It'd be a lot harder, to be honest, but it doesn't really change the question or the ambition that we want companies to adapt their business models to ones that are going to continue to be successful in a world that's decarbonizing. So I sort of feel like sometimes we get a bit too stuck on needing perfect data or needing more data and needing to spend more money on data, rather than just thinking, well, actually, even if the data is imperfect, we can understand the direction of travel. And actually, within climate change, personally, I'd say, don't quote any of my bosses on this, but I reckon if you put your mind to it, you could do a reasonable job with free data from enough carbon data sources that already exist without really having, you'd still have to do a bit of Excel-based work, but it doesn't have to be a huge data exercise or a hugely costly exercise to understand where portfolios are or where individual companies are, at least in broad terms. CDP is a great resource as well.
Sorry, we've pretty much reached the end of the session, I'm afraid there. So I'd just like to thank Andy for fielding a number of those questions. So if you could just help me, thank you.